Hello, Ryan Garland. I am your host of The Paradigm Shift. I cannot wait to expose the true inner depths of institutional wealth building and how to dig deep into real estate investing. What's up, everybody? Good afternoon. I am in Park City. I am at a little Airbnb. I'm in this little dungeon down here. And I'll just kind of shoot the crap with you guys a little bit just to kind of give some time for people to log back in. We had a good sign up audience this time, which is, it's kind of growing more and more just because I think our awareness of what we're doing is kind of coming out more and more. But really kind of the idea today is just to talk your ear off. I really want to tell you guys a little bit about family office. It's a concept that most people are starting to pick up on, but it really kind of has to do with what my belief is the way the world works. I don't know if any of you have been watching the market or stocks the last couple of days, but it's been kind of crazy. So, when there's that much volatility, what you're seeing is people, even institutions, are starting to pull money out of certain stocks just because of the volatility, and they could see and forecast kind of where the world's going. And like, for example, NVIDIA, and you saw Michael Burry, if anybody knows about the movie Big Short, which, by the way, I can walk you through that movie. So if you haven't watched it yet, make sure you watch The Big Short. It's a documentary on what happened in 2008 in the market crash. And it's really kind of eye-opening on how the institutional world really works. And, us peasants down here at the bottom get kind of reamed for it. So, but with that said, what happened in 2008 is kind of driving, people nowadays into starting to manage their own money, meaning, a lot of people are stop more day trading. They're using AI to start investing. They have certain risk tolerance. They're dumping with, for example, if the market's starting to drop, you have all this AI that's managing other people's money, and they'll start dumping stocks. So you'll see this volatility. That's why stocks are going so up and some down and up and down. The ones that are really making money are the actual day traders, the humans that are still active and buying stocks when the market drops. So really the idea is what is family office, right? That's the biggest things. Like, what the heck is family office? You're starting to see me post more about it. And it's not a concept that's new. It's been around for a long time. And so I'm going to kind of give you more of a high level on what that is. Then I'm going to work your kind of way down into what it means to groups like us, right? Smaller allocators, guys that have kind of created niches that manage funds and kind of have a specific business strategy. So think of a family office as a high net worth client or family, maybe an institution, Coca-Cola, Johnson & Johnson. What they'll have is a large, legal firm and advisors that are managing all that money, right? You have all this tax strategy that you want to implement. You want to try to, it's like when you build your wealth, you want to try to retain it, right? It's one thing to make it, it's another thing to keep it. So when you have so much taxable income, you really want to focus on certain strategies to park that money, allow it to accumulate more wealth instead of paying Uncle Sam, and then eventually, pay Uncle Sam down the road or defer it as long as you possibly can. So what happens is the family office concept is where, you'll have a subsidiary of a large institution that's a small advisory firm that has kind of a niche plan on their strategy or an understanding of the market, where they'll invest in certain technology or certain trades or annuities, insurance, there's all these different investment classes. And then you have kind of the alternative market, oil and gas, you have gold, you have commodity trading, and then you have real estate, which obviously that's my background. So we're going to talk about that. So I want you to think about this. Most people want diversification, right? So diversification in investment. So let's say, for example, I'm going to pick you, Atlas, because you and I are really close. So Atlas, you got $5 million. You've worked really hard. You're in your 50s and you're like, you know what? I got $5 million from the sale of my company. I don't want to put all my eggs in one basket. I want to diversify. I know some stocks. I come from the tech world. I'm going to stay in tech because I understand it. But I really want to diversify into real estate because since I've raised a family and a lot of my wealth has been in real estate, I want to stay within that because it's something that it's tangible. It's something I can rely on. It's always been a hedge against inflation. It's always, they're not making more land, right? So it's always been safe to buy land and develop. And so we're kind of that firm that goes out and raises our hand and says, hey, with your diversification model, Mr. Wealth manager, we have all the security instruments and we understand managing funds and we have the reporting and compliance and we have all that stuff for you to feel more comfortable to invest with us. But we're also focused on real estate and we have a niche group, right? We focus on storage, we focus on single family, we focus on health and wellness, whatever the case may be. And then inside that asset class, those wealth managers go, well, we like apartments, we like retail, we like certain geographic locations. you have all these different metrics that these wealth managers come up with for their risk tolerance and risk model. So that's kind of the high level family office. Okay. Now let's dumb it down to more of the, I don't want to say low level, but let's just say groups that are starting raising capital, maybe have done $1 billion in transaction or less. That's probably the better way to say it. So in fact, one of our big announcements is that we just got just backed by a family office that's local in Lake Havasu. And I'll share with that maybe down the road, but that's a big deal for us because now we don't have to do so much crowdfunding. We have one large check writer that's going to allocate into multiple projects and get the diversification. So they're not going to put all their eggs in one basket, right? So for us, you're starting to see me utilize social media and that platform to build awareness for family office. But what you're seeing is that I'm burying it inside the health and wellness aspect. And what I'm targeting is the healthcare. And healthcare is the fastest growing industry, period, end of story, right? You have baby boomers are becoming more frail. They're the ones with all the money. And they're the ones that are going after, they're the ones with all the health issues. So they're investing more and more into their health. And I don't know if any of you are sitting down with any baby boomers that have gone through some serious health issues and they're trying to allocate money to get additional income to cover those costs. But it's a very sensitive subject. And so they're going to be very careful in which direction they're going to invest and who they're going to invest into. So from us, from the way we play is we kind of look at it and go, hey, look, we understand that. And we know that health and wellness is the fastest growing industry. We're going to kind of piggyback off of that. And for those of you that know this, our Lake Havasu project, our big Barn Caves project has a 40,000 square foot gym, which by the way, we should have our permits by the beginning of January and actually like physically break ground. And once we start, we're not going to stop. So that's a big plus for us. We've been waiting on that for a couple of years. So we're very blessed. But you know, what's happened is, and I'll kind of give you a quick backstory just to kind of close the gap a little bit. Because we're in Lake Havasu, it is a secondary market. Now, when I say a secondary, like a serious secondary, meaning the Census Bureau doesn't even report properly what the income levels are, the income levels are income, and then population growth level is. It's not accurate. You have to kind of go to a private third-party feasibility study or market study like Green Street Advisors. I've shared that with you. If anybody is really looking at opening a fund or managing real estate, Green Street Advisors is a good firm out of Newport. But you have to get this third-party study to be able to identify what's really happening. So it's kind of a boots-on-the-ground study, chasing down DMV records, how many people are actually moving into Lake Havasu, right? You need real data points where Census Bureau just isn't scrubbing those type of platforms. So with that said, what we did is we wanted to go out. Ultimately, I wanted to just build the shell, right? And then I would bring in an operator. I would give a TI credit, tenant improvement credit, and I would, build it out the way that a gym would want. And I wasn't going to manage the gym. So I've gone out to multiple gym operators, like the EOSs and the smaller private gyms as well. And what I'm realizing is that a lot of these guys, they're just not business savvy. I hate to say it. So unless you're dealing with the corporate side, it's going to be hard to find the right sophisticated player to understand Lake Havasu because it's such a niche market. And so what I've created was, in essence, a business plan for us to manage a gym on our own. So we've looked at all these different models, and I have a lot of support, by the way. I mean, for those of you that know, a lot of people that work for me have been in the health and wellness world, fitness world, and have opened up multiple gyms. And so by osmosis, I think we just have the support. But we're going to own and operate that gym. Well, when you look at EOS bought, had two different slugs. They bought, not World Gym, but what's it called? Gold's Gym. And then they just had a second acquisition as well. So you're seeing, and then if you just look at the data on, where the health and wellness is going as far as gym signups and, food even, by the way, health and wellness is growing faster than, and I've said this before, but it's the fastest growing industry. But you're watching even from the food industry, there's a 9.4% increase per year in more production of farm to table type of lifestyle. With everything politically and what's going on and all the exposure to all the unhealthy stuff that's in our food, people are pushing back and they're wanting to go more health and wellness. And then you have the everything that happened with the pandemic. You have physicians kind of going back to the old school way of, advising their patients to go back to eating clean and working out. So you're seeing a massive uptick in activity at gyms, and specifically more private gyms because they have better amenities. It's a little closer to the heart. The corporate world just really cares about numbers. They're not really providing much value after that. So I think what you're seeing, especially in a small town, is that type of business strategy. So with that said, what's happening is what we're kind of becoming more diversified as we go. And so with going into more in the health and wellness world, we said, look, with it being the fastest growing industry, why don't we just name the gym Family Office Society, which I've owned that domain for a long time. I have the Instagram. I kind of grabbed onto it a long time ago, knowing that was the wave of the future. Now we're kind of piggybacking off of that. So with that said, what's happening is we're kind of opening up the doors for additional cash flow for the company, which creates more sustainability. So as we sit down with our larger check writers and say, hey, look, here's the sustainability for the company, we're going into health and wellness, and then we're also looking for larger check writers, it makes sense to them, especially when you look at the barn caves model where you have residents that we're going to build and sell, and then we're going to keep the gym. Now, for those of you that know about my debt fund, my $100 million debt fund, my background is in lending. So I have a $100 million fund now that we're doing kind of more of the bridge loans, ground up construction, fix and flips, what have you. And what we're doing is we're actually converting a lot of those loans into, because the note buyers have kind of faded. So we were funding loans and selling notes. And since that kind of game has left the building, if you will, we're kind of taking our fund and we're investing it onto assets and doing long-term holds. The reason we're doing that is because we can't turn that capital unless the loans are paying off by standard practices, by refinance or sale. So after we lend to them, and let's say it's a builder, he's building a home, he's got to build it and then sell it, or he's got to build it and refinance it, right? So when we would fund the loan back in the day, we would fund the loan and trade that note within 2 to 3 weeks, recapitalize and put that money back out to work. And we would get our fees, and then we get our coupon, and we'd pass that coupon over to our investors. Well, because of the shift in the market, what we're doing is we're amending that fund, and we're building these gyms and ultimately using the money to take out the gym capital, if you will, and then we're converting it into a REIT. So the secured income fund, we can actually elect to a REIT. So our investors now will get some tax benefits on the cash flow of that, which is big. So what's happening is we went into kind of this fix and flip in and out kind of model to more long-term holds. So it kind of aligns with where the family office is, the higher net worth investors, the baby boomers. They're looking for more stability, and they're looking for more cash flow, but with some accumulation as well. And that's what these are doing. So we've kind of married up where the capital market is going and what we're currently doing and how we can marry those up together. So ultimately, we're chasing down family office. And I hope that makes sense. For those of you that have any questions about family office, feel free to start asking questions, and I'll kind of stop and keep going. But I think this is important because a lot of you that are actually on right now, I met out in Tulum, and I really appreciate all the support. But what I'm seeing is a lot of people are coming to me going, hey, I want to manage funds. I want to start, or open a fund. I want to start, developing my own projects. I want to, whatever your practice is, short-term rentals, long-term rentals, build to rent communities, gyms. I mean, whatever you want to do. One thing that you want to create is a financial model where you can go out to the retail investors, right? The smaller players, the $50,000, $100,000 check writers. But then you're also going after the check writers that have massive taxable income, and you want to implement tax strategy. And that's where some of the wealth management practices come in. So when you're utilizing some of that stuff, meaning tax strategy, you can start raising more capital, because again, the more capital you have, the more wealth you've created, the more wealth you want to retain, right? I'll use this as an example. I know a lot of people have signed up off of my post on Instagram and this link. If you guys saw me yesterday, I posted something about a cost segregation study. Now, ultimately, what that means is that because of the nature of the development and the product that we're building, we can get tax credits on that product. And ultimately, what that does, it allows me to assign those tax credits. And as you guys can imagine, my overhead is high. I pay a ton in income tax, and then I pay a ton in payroll tax and tax. It's a nightmare. So for a group like me, if I start retaining assets, I can actually chase down the tax credits. Now, that was a $1.9 million tax credit on just my headquarters building that I'm completing literally next month there in Lake Havasu. And that, I got a $1.9 million tax credit that I can assign to my corporation, where all my payroll is and all my management fees go up, all my profit goes up there. So all my income comes there. And then I can write off a lot of that income. So imagine that. So what that does for me as an operator is it allows me to hire more people, create more sustainability, because I have more of that income that I've been able to retain. So now I can actually, so again, I'm not paying Uncle Sam, so I can start hiring more people. So it's a strategy overall, right? So when you're talking to investors, I can actually assign those tax credits to them as well. So as they, let's say, for example, as you guys know, I have a lot of equity offerings on my platform, right? You can invest into the barn caves. You're in for 4 years. You don't give a dividend for 3 years, and then you start getting paid out. And then at year 4, you get all the way paid out with your equity kicker. During this time, like since I'm doing, solar and some other tax credit plays, I can actually assign tax credits to my investors. So your standard ordinary income. So what you do for a living right now, let's say you have $100,000 in, to invest, you invest with $100,000 to me, and I have tax credits in the project. I can now take those tax credits. I can pass it to you each year. You can take those tax credits, file taxes, and the taxes on your ordinary income will come down. So what's happening is that these investors are going, hey, I got 100,000 in IRA, 500,000 in IRA, whatever the number is, and you can assign tax credits to me, and I'm making $200,000 a year, and I can save having to pay Uncle Sam so much of my standard income because of the investment with you, Ryan. I can send those tax credits over. Does that make sense? So imagine that. So for example, anybody who's on a W-2 now, which most of my employees are on a W-2. Imagine if let's say they're making $10,000 a month, which is kind of standard at my firm. You're making $10,000 a month. Well, you're paying $3,000 in taxes every year or every month. So you're only taking home $7,000. Well, imagine if you're saving another $1,000, right? So an extra $1,000 for someone who's on a salary is a lot of money. So now multiply that by hundreds of thousands or millions of dollars. You can imagine how much that is beneficial for these investors. So with that said, the family office concept is the fastest growing high net worth and individual investment movement, period, end of story, across the country. If you guys have watched some of the things that I have going on in Dubai and Abu Dhabi, and I've traveled the world, I have been raising capital in those countries and bringing them into the US. And the reason to do that is because the high net worth clients have so much, like for example, in France, the tax rate's 50%. So a lot of these investors open up, an entity in Monaco because there's zero taxes there. They invest from a Monaco entity into the US. We're typically the operator to help them make that placement. Then when the profit comes back, it goes back to them into Monaco. That's just kind of one example, right? And then they do with it what they will and maneuver around for taxes. So that's why you're seeing so much money coming into the US. So again, we're that firm that goes out there and raise our flag and say, hey, look, we have tax strategy, we have consistency, we have the right product. This is, where we're in the secondary market. We have massive growth. I think for those of you that are in Havasu, I think we made the LA Times talking about there's so many people coming into Lake Havasu and migrating there than anywhere else. I remember exactly how the publication was, but it's good PR. So ultimately what I'm doing is I'm just pivoting, right? We're just watching where the market's going, and I'm just creating a product, an investment strategy that is catering to what's relevant in the market. And that's really important, shifting to where the market is going, but understanding what your audience, your investors, and what they're really looking to do. So that's kind of that ears to the ground kind of model, right? You want to know what people are looking to do, what they need, and they're going to have that common theme in these conversations: taxes, income, health, and they want to believe in the people that they're investing into. So that's really kind of the family office concept. So with that said, I'm going to kind of share with you guys a little bit more in detail on the strategies that we have so that you guys can take this away and maybe implement it in some of the things that you're doing. Kudos to some of the people that have been watching your guys' flips. You're doing well. I can see that you guys are advancing into larger projects, and that's kind of how it works. So Nick, good for you, but I've been watching you. You're doing great. With that said, let's talk a little bit about the flats, which is that 4 acres that's in town of Lake Havasu. That project is so desirable that we, for the most part, have already stacked the deck. So we only have 3 investors and go for it. And I haven't even finished my renderings yet. Now, what that means is that we built the track record, we built the trust, and we have investors that are going, hey, if I write you a check for $4 million, how can I get tax credits for that? How can I save money? What's my security instrument look like? And how does this overall work? So I'll kind of give you an idea. So not only the product that we're doing underground, as far as all of our underground development product for sewer water, storm drain, sewer product. So basically all the piping, certain materials that we use, we can get additional tax credits. Okay. A lot of people don't know this, but we can implement that. So again, as an investor invests, I can pass tax credits to them every single year based on how much I've invested into the construction so far, even though, as you know, there's multiple phases. And now these investors can actually get some additional tax credits. So if you're implementing tax credits to your investors every year, it's probably the best strategy that you can start implementing into your business model. That is a 68 unit product. It's going to be a hybrid between Paradigm Storage and the barn caves. Paradigm Storage is zone, regular commercial, storage industrial, where you have just, a big unit. You can just store your stuff, your boats, RVs, or you can kind of make a little man cave out of it. That's, you guys have been following me, what I've done. But you can't live in it, right? It's kind of it's a 60 or a 60 by 30, and that's kind of all you got. It's just a box, right? And then you can customize it. But again, you can't live there. And so the barn caves is different. I have the same size garages, but 2 stories of residential above it. So it is zoned single family residential. So it's a little bit different, but that's what people are wanting. And if you look at Lake Havasu, that's standard. It's, you have your regular 3-bedroom, 4-bedroom house with a big RV garage and a standard 2-car garage. Same concept. I'm just going vertical and making it more dense. So you kind of have to implement those strategies to try to do as much volume as that we're doing, as far as tall skinnies and going vertical and getting your setbacks a little tighter. But you can make more money, and then you can cater to an income levels that, if no matter what the volatility is, it's a product that people are going to want. It's a new product. You're implementing technology, and people love it. So we're going to implement that same building method into the flats. Now, the barn caves is a detached product. Okay, it's a townhome detached single family unit 1, right? The flats is more of like a condo model where you have shared walls. So the costs are going to come down. So we have 3 different floor plans, and it's going to go from $380,000 to $800,000 as our exit sales price. So for those of you that know Lake Havasu, that's unheard of to buy a new house that's a 3-bedroom, 2-bath house for $380,000. That's like, where you're going to find that with a 40-foot garage. Then we have the 60-foot garage, double wides, and you can go all the way up to $800,000 and go up to 2,200 square feet. All of them have rooftop decks. So again, this is going to be zoned single family. They are townhomes. It's different than what they call it out in Havasu, but it is townhomes, even though they have shared walls, which standard is kind of conversations is normally for condos. But it will be more of a townhome product. And, it's a for sale product. Same thing. We build it, we sell it, we trade it, we make our investors money, and we move on. That's a 2-year product. Barn Caves is a 4-year product, right? Where like the Barn Caves gym, that's a long-term hold. So what's nice is investors that may want to convert some of their equity from the Barn Caves, they can roll it into the gym and start getting those tax benefits from the cost segregation study that we did. And that really kind of allows them to stay into more long-term cash flowing assets. So that's what you're seeing with Paradigm, is we're implementing a way to create wealth by accumulation, equity, plays. And then you can back into more of the debt pieces where you have more security, something that's a little bit more stable. You have a little bit more cash flow. And so you can diversify in all those models. The direction that we're taking is probably a little more unorthodox. And for those of you that know me, that's kind of who I am. I've always been kind of a disruptor. And what we're doing is we're implementing these gyms into what you call family office society gyms. So what we're implementing is this, think about it this way. As you know, our marketing is insane, right? And it's always about strategy, how to build awareness, but try to do it for cheap or for free. And so as the family office concept grows, if we have the right SEO according to the website and it marries up to our standard Paradigm company site, when people are starting to Google family office, we're going to have so many of our own members posting stuff and going to that page. It's going to drive that traffic and push us all the way up to the top. And then we're going to create a hybrid between, hey, you can invest into all the things Paradigm. You can look at the health and wellness component to us. You can look at all these other assets, but we're utilizing the family office name to build and rank to then build awareness. So some of that strategy is also very important, because then again, we're getting more people to look at what we're doing. As we continue to show proven track records, more and more capital will be allocated. So between taking gyms and converting them into REITs and taking them as long-term, cash flowing assets for the firm and for our investors, then you have the kind of the in and out model where you're accumulating, wealth, and then you have all real estate based. So when you're going after these high net worth investors, you want to be able to give them a roadmap and make it very clear with market studies and all the right mechanisms to have them understand what it is that they're getting themselves into. All right, let me see if there's any questions so far. A lot of hellos and highs and stoked. And all right, cool. Okay, so let's see. What else I want to touch on today? Um, I'll kind of give you guys an idea what, I'll tell you a story. I'm going to give you guys a story. So in 2008, it's funny because I just brought this up the other night. We watched Big Short. If you haven't watched The Big Short, do me a favor, watch it. Feel free to write me. I'll walk you through it if you don't understand it. In 2008, and this is how I cut my teeth, and this is where I think you guys will see, this is what changed my life. It actually allows me to maneuver, and hence the name Paradigm, but maneuver around certain market trends that can become negative. So in 2008, I owned a mortgage company. And as you guys know, the market crashed, and I was having my first son in 2008. I couldn't even put food on the table. And I ended up going to all my buddies. Now, mind you, I had an office. I had a house that had 5 bedrooms, 6 bath. It was like a party pad. It was a total Wolf of Wall Street, just a little cleaner. But it was a party pad. That's the way it was back in the day. And when the market basically tanked, we went from, I had a big call center. We were slinging loans out in like Florida, wet states. It was just titled, no escrow. We were closing in 3 days. It was wild our day. We were closing so many. We were doing like 100, 150 deals a month. It was wild. Well, when the market crashed, we went to like 1 a month. So it went from big overhead, no income. We knew it's going down. So I went to my team on Monday mornings, and still to this day, I have 9 o'clock conference calls with my whole entire team. And I said, hey guys, I have an idea. I think, why don't we do this? Since the market's not going to turn around, I'm going to lose everything. I got probably $80,000 in savings, and we're going to blow through that next month just sitting on our hands. How about we go to Vegas? We blow all of our money. We go one heave-ho in Vegas, and then we come back. We file bankruptcy. We live in this house for like 2 years, and we all become pizza delivery guys. And every single one of my buddies were like, dude, let's go. Let's rock and roll. So Friday night, that's exactly what we did. I got a private jet. We went out of Riverside. We got into Vegas. I think we ended up at like Hyde, which is right there at the Bellagio back in the day, right over the fountains. It was more of a lounge club-ish, if you will. It's like 2 o'clock in the morning. I'm buying bottles for the entire club. I'm like 40 grand deep in drinks. And this really wealthy Asian guy comes walking up to me, and his name was Kim. And I don't even know how to pronounce his last name, but he was a former family office. He was a pension fund manager from China. So I found all this out later. He was a pension fund manager from China. He retired out. He was watching what was going on in the mortgage-backed security market. So again, the financial crash, 2008. So he knew what was going on, right? And he saw it coming. So what he did is he came up to me and said, Ryan, he asked me who I am. And I told him the story that we're out here kind of doing my thing. And he goes, yeah, I kind of like you. He goes, here's my business card. Do not forget, but you need to come to my office on Monday morning, 9 o'clock. And I didn't. Something told me not to forget this and to be there. He was wearing an IWC watch on, Prada glasses. I don't know, it was probably Prada. He was just very polished, but spoke perfect English. So Monday morning, we're all in it. We're actually all in a limo. I have like 9 of my buddies with me. Mind you, these guys, they partied all weekend. I'm like the only normal sober one because I can't drink. I just don't know why I can't party like that. So we pull up to this thing. We're in a limo. And we pull up to this office, and we all get out, and there was security at the front door. And they said, Mr. Garland, and I raised my hand. They said, okay, only you can come in. All you other guys need to go eat over there. And they had a lunch truck. And so this guy, Kim, had a lunch truck for my buddies, but he only wanted me to go in. Okay. So they let me in the doors. They walked me to an elevator. As soon as I get in the elevator, I had another group, 2 guys that were another security. I come up the elevator. I was like, I don't remember what floor it was, 12th floor or something. I go up the elevator. They open up the elevator. 2 different security guards take me, and they walk me through this aisle. And it was one whole floor of this building. And it looks like a movie. I'm walking through this aisle, and on both sides, there were a lot of Chinese people with the smallest cubicles I've ever seen in my life. Like, it's just ironic. It was just weird. So I'm walking through the middle of this aisle. I go these huge doors in the back, French doors. You open them up. As soon as I walk in, and it was an auction from an FDIC that was hosting it for basically billionaires from all over the world to come in and buy out banks that were underwater, or buy all these defaulted assets. So tons of mortgages, tons of credit card debt. Basically buying banks. Inside that room was the CEO of Countrywide, New Century. Wachovia was in there. Chase was in there. Bank of America was. These are the biggest, and they all had their own private security. And basically what it was is that, and this is what the point is, the larger institutions and the news and all this shit, it's never honest. They don't tell you the truth, okay? Back in the day, they said the FDIC came in and bailed out all these banks. And, I remember B of A bought Wachovia, and all these banks went under and gobbled up, the bigger banks gobbled up smaller banks. That's not how this went. And so this was kind of a vantage point that changed my career. What it was is that this Chinese guy was so smart. He went to, and it's ironic because I actually knew one of the attorneys for the FDIC. He had retired at the time, but he was an attorney. That's how he walked his way through here. And he ended up basically working a deal saying, hey, look, you guys have an issue with managing these assets. You guys, with your current bank platform, you guys can't manage the short sales or the REOs. You need someone to come in and basically help you repurpose these assets. So if you guys have $600 million in distressed defaults and distressed assets, who's going to manage those? So what workforce do you have internally to manage it? Smart guy. And he always told me, he whispered in my ear, he goes, Ryan, the people that made all the money during the gold rush were the ones that provided the picks and the shovels. And it was so true. So I'm sitting in this auction room, and you have all these billionaires from all over the world. And what the idea was is that it was an auction block. It wasn't like as cheesy as you go on to an auction and you put up a paddle, but it kind of was. And what they did is what you call heat signatures. They had this huge whiteboard projector, the whole thing. And they were showing down to, if you guys remember this, or anyways that haven't been in, were involved in back in the day, you had Pulte Homes, KB Homes, Standard Pacific, Beazer, all these developers, all the way down to like they owned mortgage companies, and they had loan officers sitting in the was it the pre-sale houses or whatever, and you go to buy a new house at a track, can't think of the word, but the model homes, right? And they were slinging 228 LIBORs, option arms, negams, all these adjustable rate mortgages, like the whole thing. And so what they did is these heat signatures were identifying where a lot of the growth was. Like, let's just say Vegas had the fastest, basically it was the foreclosure capital of the country, then certain parts of the Inland Empire, and then certain parts of, Texas and so forth. And what they were doing is they were showing all of these mortgage companies that these loan officers inside these builders were basically slinging all these mortgages to, and they can narrow it all the way down to how many women had mortgages, men had mortgages. I mean, married couples had mortgages, the whole nine yards. And basically was helping these guys, sell these assets. And they would say, hey, if you buy this portfolio, inside this portfolio are all these regional banks that have these locations, that have employees, that also have credit card debts and car debts and all. I mean, you're literally watching them buy banks. The problem is that, or the best thing that Kim did is he was providing the back office. So if this billionaire is going to buy all this distressed assets, who's going to manage it, right? So what Kim did is he had all those people that are in those cubicles as asset managers. So if you were to buy, basically buy let's say an $800 million distressed portfolio for 50 cents on the dollar, which is, I think, averaging 45 cents to 55 cents, he would use those analysts and assign those analysts to then work with real estate agents to do REOs. They would do all the inspections and BPOs, and they would do all the heavy lifting to identify which asset, how to comp it, what should they sell it at, what to negotiate short sales at, the whole nine yards. This guy was brilliant. So he comes up to me at the end and he goes, what'd you think? And I said, well, I told you I was a broke white guy from Inland Empire. Why? Like, I have no money, dude. I'm watching all these guys do all these trades. I'm absolutely broke. He goes, well, there's a difference. He said, look, I'm going to give you $30 to $50 million per month. I want you to go repurpose a bunch of distressed assets. So I need you to work directly with real estate agents that had relationships. So top agents that have relationships with clients that are going to try to, now check this out, and it's important, that a lot of people back in the day were they were embarrassed to say they're going through hardship, and unfortunately, one of the fastest growing divorce rates are always based off of income. Financial hardship is the biggest driver. So it was really hard for a lot of people back in the day. So what we were doing is we're going to these agents that were working with their homeowners, and we were buying these houses at massive discounts off market. So a lot of these people were working with these agents, and we were going in and working with these agents again to be the straw buyer to buy these houses. And what we did is, and then what we were trying to do at first is he wanted me to focus on mortgage-backed securities, basically refinance these people out of the bad loans that they had, right? So after about 2 months, I went to him and said, hey, look, I can only put $6 or $7 million out because I had to still do verification of mortgages, verification of income. I still had to do all of this. And so, if people are losing their jobs, they don't qualify to be able to pay for the rent if we were to, pay for the refinance of their house. So I was only able to get $6 or $7 million out a month, and he wanted me to park 30 to 50. So I'm sitting there going, okay, I don't know another way to do this. And he calls me and says, Ryan, if you can't place that type of money, I got to go another direction. So he was basically my only lifeline at the time. So I thought about it over the week, and I said, why don't we do this? Why don't we go in, and since they already have relationships with with the asset managers, why don't we target specific paper like Wachovia, Chase, Bank of America, certain banks that are a little bit behind on the short sale process. And what Obama did good back in the day was the Forgiveness Act. So instead of a foreclosure, if you were to short sell your house, the default, the delta between what the payoff was and what what they actually traded at was forgiven, right? So the debt was forgiven. And then you can go FHA and buy a house again 3 years after a short sale. So I was like, why don't we do this with kind of understanding what's going on in the game? Why don't we go to all these agents, go to these homeowners and say, hey, if you can't refinance, why don't we buy it and then lease it back to you and then give you the ability to buy it back? So it's still a financial model, but we were only buying these at like 70 cents on the dollar. So now, instead of trying to refinance the high mortgage and see if they qualify, we were cutting down the principal balance and then qualifying them off of a much lower amount and giving them in for rent. And then 36 months later, they can actually purchase the property back. When we launched Paradigm's brand was opened up in August of 2009. This is the start of Paradigm. And we ended up doing, I think, 276 short sales for $33 million in November. And we just started banging from the rest of 2009, 10, and going into 11. And the reason I'm telling you this is because I learned so much about how the corporate world works and how they are, in essence, creating a lot of problems for the working class, that the working class now is onto it. So if you have people that are day trading and you have investors, they don't want to fall in line anymore with the corporate world. So you're seeing a lot of people pull money out of stock market, managing their own money and reinvesting it in their own ways and having more control because they just don't believe in the larger institutions. So what I'm doing is I'm going, hey, here's my experience and what I'm seeing going on with political problems and NVIDIA, and then Michael Burry saying that NVIDIA is basically announcing that they're 26.9% higher in returns for their investors, and that's inflated. And mind you, he's the guy who nailed down the CDOs back in 2008. He was the first one to catch all that stuff. So a lot of people listen to him, and he invested in a lot of water rights. He's a very smart guy. But anyway, so that's kind of what you're seeing is this huge shift because of the volatility, and people are just not comfortable staying in the stock market and staying into alternative asset or in certain asset classes. They're moving more into alternatives and they're trying to get more into real estate. So I think what you're going to see is that over the next 2 to 3 years, real estate's going to be kind of the direction that people feel more comfortable being in because it's more consistent, but you're also able to capture it. So if you're an operator and you're managing a fund, you can start raising capital a little easier because that's where people are leading. They want to manage their own money. They want more transparency. They want to invest in somebody they can call at 10 o'clock at night if they're worried about something. It's kind of wild. So as an example, my relationships with my investors skyrocketed when Trump was shot. And what happened is that immediately when I found out, I did a big mass text to my team and said, hey, mandatory call in 1 hour. And then I wrote an email to every one of my investors and said, hey, I will give everybody an update and we can schedule calls. We could talk this through, but I'm going to watch the market over the weekend and I'll give you guys updates. And I wasn't wrong. So what that does is it creates trust with people and it makes them want to reinvest and continue to invest into you, but they want to stay more in real estate. So if you kind of think of everything that's gone on in the last 4 to 5 years, given with the pandemic, people just don't trust the government anymore. People are just so nervous about what's happening in the world. I mean, the fear. So I'll give you an idea. Most of my calls, it's 5 minutes about the investment strategy and another hour of like my philosophy investing, my backstory, the problems we've had, how we overcome the problems, litigation, how I've had to do this, or I've had to respond to things. It's just the way the world is right now. So it does open up doors for investors operators to collect larger check writers and investors. And those are what you call family offices. They're repurposing their capital. They're allocating more into real estate. They want something that's more stable, and they're managing their own money. And some of the larger players will have advisors. Well, they'll work with Schwab or they'll work with Fidelity or they'll work with JP Morgan, and they'll have their own advisors. But even those advisors are telling their clients to invest into real estate. So again, if you have someone who's extremely high net worth, 100 million, 50 million, 100 million, that's playing with capital, they may have an advisor at a big bank. And even them, they are saying, hey, yeah, go ahead and allocate more into real estate. So if you have the right PPM documents, offering documents, the right strategy, the right data supporting your investment, the likelihood of you're capturing some of that capital for you to go develop is high. So, okay, so let's I'm talking fast because I'm trying to get as much in as I can here and make it worth your time. Any questions for now? I don't see anything yet. Okay. Okay, update real quick. Some of you guys are existing investors. Quick update. We are amending our secured income fund. I kind of talked on us earlier. Our secured income fund has really kind of been the hard money lending, fix and flip, selling notes. As I mentioned before, we're going to advise that and start building our own specs. As we have gone more into development, we are realizing that lending money to other people that aren't as sophisticated or have a team behind them is more problematic because of the volatility in real estate in certain areas like Baltimore and certain areas. We've had to foreclose and take properties back. So I think our foreclosure rate popped up to about 30% over the last 12 months. And because I've been through 2008, people are trying to file bankruptcy and strategically stop the foreclosure that I'm taking back. So as a firm, we got to a point going, you know what? I don't want to lend money to people as much anymore. We can capture that money. And by the way, most of my investors have diversified, some into that one, some into other projects. And when I go to them saying, hey, market's shifting, I'm shifting, I'm going to take that capital and go build, basically my own projects with it, which is a lot. It's going to change, kind of the direction paradigm's going, but also accumulate a lot more assets a lot faster. We're probably going to see a 200% growth in 2026, just simply because I'm going to take the capital I already have under management and I'm going to go in a direction that's more development. Kind of piggybacks off what we're doing right now anyways. So that's one for the SIF. So if you are watching this and you are a SIF investor, we should have the amendment today. Steve Anapol, our attorney, Carlton Fields, if anybody wants to work with a good attorney, he's not cheap, by the way. I'd look him up. Carlton Fields, he's a partner. He should have that done later today. Barn Caves is going really well. We're hoping that we're going to have our permit for the gym. I know I touched on this, but just to close the gap here, early January. They have told us into December, but I don't believe that because like all the PTO that the city employees accumulate towards the year, they typically take 3 weeks off in December. So I've been down this road with the city, so I know how this is going to go. So I'm just kind of throwing it out there in January. So we're narrowing down all of our construction contracts right now and starting grading and block walls and underground and so forth. So once that starts, it's not going to stop. And as you guys know, I'm going to go nuts on social media. That's it's a big positive for the company. Flats, we close on January 9th. All the capital's already been raised. I'm already into engineering. My architect was out here with me the last 3 days looking at some other projects here. And I won't share with you guys yet, but I'm looking at something here in Park City. But we've already done our design. All the floor plans are done. Site plan is done. We've already done the kickoff meeting with the city. They love what we're doing. They've been really wanting to get this 4 acres built out a long time ago anyways. I mean, it's kind of a sore thumb in the city. But we figured out a way to make the numbers pencil. They're giving us incentives because we have built a great reputation. And so we're getting a lot of support. So that's very helpful for anybody that is, that's a part of the city that's watching this. I want to thank you and for all your support. So that's going to go well. That's a 2-year play. It was a $6 million raise, kind of a slam dunk. We have one family office that came in. And then for those of you that know my broker, he's really heavy with me. He's $3 million in with me now. He's going to rotate out of some of the projects and into some of the other ones as well. So it's really kind of a family, right? He's pregnant. So he's going to be focused on selling this because if he doesn't make his money back, right? So it's kind of nice for me to not have to worry about the sales side. Boathouse is going to be done in January. That's a small little, like kind of a same size as like a phase 1 of Paradigm Storage. That's almost done. That's kind of like a slam dunk deal. Paradigm Storage, we're slotted to complete building G, which is Millionaires Row. We're hoping the end of March. And then for those of you that are watching my headquarters building, that'll be CO'd hopefully by the end of the year. Hence me trying to get that cost seg in place so I can capture the tax credits for this year and write it off. And that's going to be fun. And I have kind of a little secret, but I can't share it on here. You guys will probably appreciate what I'm doing with that building. But you guys, that building is from what I'm hearing there's some announcement within the city saying that's one of the most well-built buildings in Lake Havasu. So we feel pretty good about that. Maybe some new building practices that the city may be able to implement off of our strategies or kind of our techniques. Let's see what else. I'm looking at buying another gym. Working on that. It's just kind of a value add deal. It has real estate in the back where I can actually build some of the flats on that as well. I bought a lot up in the foothills. I'm going to be building our first specs. So Paradigm Homes, we're launching that brand. So we're going to start building smaller specs. And these are going to be just like kind of prints, right? I'm just kind of like the 4 bedrooms or 3 bedrooms, 3.5 bath for the house, casitas in the back, pool, try to get in a view for the lake and just kind of trade that and just bang that out. So we're going to launch Paradigm Homes, and we're probably going to do maybe 3 to 4 a year. We're going to kind of ramp up. Obviously, it takes time to kind of go. So 2027 is probably going to be a pretty big year for us. We'll have maybe 3 or 4 that we can trade by 2027. Let's see. I think that is it on the update of what we're doing. Again, targeting more family office and utilizing marketing strategies to build awareness. All right. So Atlas, outside of financial investments, where could we add the most value to this project or anything else we're working on? I will kind of just piggyback off that. If anybody wants to raise awareness for, the flats, I think is pretty much done. I would say the barn cave. So what I did, you guys will probably appreciate that. So this is really important. The way that the model is on the barn caves is, so you have the acquisition of the land, you got planning, approvals, entitlements, right? You got all the other design, you got to go through all that. What I did is I have a $15 million raise. What you always do is you always do your financial modeling as if you raise that 15 million and you're accumulating that preferred return for your investors on day one. Okay. Assuming that's when you close. Because when I raise capital, unless I'm using some of that to close on the land, I will allocate the clock actually starts when we actually close. Okay. That's how it works. Excuse me. So what I did is I knew that it's going to cost X amount for the land, X amount for planning, X amount for entitlements, right? The whole thing. I raised only as much as I needed. So about half of that. So I only raised 7.5. I'm now going to market. I'm just going to kind of cruise through December. We'll throw a little marketing campaign out because people are trying to park money for taxes and so forth. And then we have the tax credit. So if people invest now, we can push some tax credits because there is some work that we've already done. Not much. So it's not really that big of a deal, but we are going to do a little marketing campaign for that, but we're going to start and kick off the raise again for the barn caves. And then obviously we're sitting on some working capital now, so we can start the grading. We've already ordered the building. So we're pregnant, man, where there's not much farther we can go except for now actually do physical labor, get the product on site. I would say, build awareness for the barn caves. We're going to try to close that out hopefully by end of first quarter. We may end up finding somebody who wants to close this out quickly. Again, our network is expanding to larger check writers. Again, those practices are important. They're seeing kind of how we using the right attorneys and right CPAs, and Juniper Square is another one that we're using. So we're going to be implementing that as well. Our investors already having access to transparency. So for those of you that are an operator, to look at Juniper Square as possibly a software that your investors have access to your website. So it links up to your website. And people can literally log into their own investment portfolio. They can look at every investment they have with you, whether it's an IRA or personal account or if they're married, separate, doesn't matter. They can go in there and basically create their own investment profile, very much like stocks, and they can invest over here. And it shows them what their projections are. They can print out statements if they need, let's say they're going to get financing and they need a personal financial statement or asset statement. They can go right on there and extract a statement that looks like a bank statement that says, "Hey, I have 500,000 with Paradigm," and it kind of shows them proof of income proof of assets. So it's a really cool model. Investors like that. That links up to our CPA. Mark is on the line too. Mark he does a lot of our back office, and he's the CPA. But they have access to all of that stuff as well, as far as your investors, and all of your investment documents they sign is in there. All the K1s, 1099s, anything that we prepare for the investors get pushed into their profile. And even dividends can be paid out through there. So if we have a 10% dividend that's going out every quarter, whatever, to our investors, we can literally populate that, marry it up to our account, and overnight we're sleeping and our investors are getting dividends. So it's a really cool model. So again, Juniper Square, for those of you that are operators, is probably something for you to follow up on. But other than that, guys, that is it. I'm trying to stay under an hour. Hopefully that was valuable. Again, family office is really the wave of the future. If you start using that and putting that adding that to your acumen, I think you'd probably appreciate it. Again, even the smaller retail investors understand what that is and are trying to become that. What they're doing is they're utilizing different investment strategies, trying to manage their own money. If you look at the data all the way down to millennials and the younger generation are starting to be more proactive in investing, where 10 years ago it was like people that were starting to get into their 50s that were just now starting to consider investing and become more serious about it. You're seeing guys that are in their early 30s that are really starting to get serious, or even late 20s. So the investment strategy, family office, allocating capital into real estate, diversification, secondary markets, health and wellness, storage is huge. Lifestyle is a trend to continue to follow. For those of you that are real close with Rich and are kind of in the hotel world, that's great. You guys are creating little, boutique hotels. That's a great one because it's different amenities. People like the experience against the lifestyle. That's really kind of the way the world's going. And honestly, I'll tell you what's happening for me. I have one of my family offices upstairs. She's writing a check for us for $4 million. What she loves is the experience. We become close. She's like family to me. And I said, why don't you come with me to Park City and go see some of the other investments that we have going on? And she's like, let's go. She's bored. Her husband wants to go to Glamis for Thanksgiving. She doesn't want to go for the first time in 20 years. She's like, I'll go hang out with you. So now we're hanging out here and we're talking about investments. And she just wants the one-on-one. She wants to see where her money's being allocated. She wants to get to know me personally. And she really wants to know more about our how we operate. Right. And how we're vetting these deals and who we're talking to. And that is how we're building this rapport. So, for those of you that are going out and raising money, you need to understand that this is a relationship business. If you do not build a one-on-one and you're not transparent, sorry for those of you this may be a little short, but it's just a common theme to say, you got to pull up your skirt and show them what you got, right? You really, really do. This is a relationship business. If you guys watch my social media, I'm always helping people. I think it's just kind of in my blood now, just because I've done it for so long. I don't want to see people stand on landmines anymore, because I've done it. I've had to learn the hard way. But again, it's a relationship business. Make sure you're building one-on-ones. Meet with them. Ask them to come and see when you're walking properties. Ask them to come to your groundbreaking events. Meet people face to face. Investors actually care about that, even though mass marketing and crowdfunding is the way to go. And that's, by the way, that's the fastest moving way. Look at Cardone Capital. Okay. Perfect way. That guy's moving into like the institutional world, but he's only staying with retail investors. He has bigger check writers all day long, but he's like, no, I'll stick with my exact team because these smaller investors have got me to where I'm at today. And he's doing billions and billions of dollars in deals. So that is definitely where it's going. People, again, want to control their money. They want to invest into the person they can talk to. Larger institutions, the suit and tie guys, they're just going to figure out a way to get their management fees and screw you. They can care less. All they want is their management fees, and they want to go, brag to their friends at, the Four Seasons and hang out with people and make other people like us pay for, to get into these rooms. And they never do anything for guys like us. So, to be honest with you, make sure that you're building that rapport, build the awareness, have the right strategy, bring in the right team, sophisticated people. Make sure you guys are articulating that strategy well and having examples of other people that have actually been successful, and then build that one-on-one, and you guys should do very well. So for all of you, thank you very much for watching. That was a 1 hour, a lot of talking. You guys heard my backstory and how I got in the business, but that was the driver of me shifting and being nimble, but understanding that those big suit and tie guys are not the ones to really trust. Sounds weird, but it's true. Again, The Big Short, if you haven't watched it, go watch it. It's kind of nice because they stop kind of throughout the movie and explain to you what's going on. But I'll give you a kind of an example. Wall Street was banking on assets to default and wanting them to. They were getting insurance policies against those portfolios to fail and wanted them to fail, which means all of us on the streets, all the foreclosures and short sales, and all of us peasants down on the ground were getting screwed. Why these guys were hoping for the portfolio to fail and strategically moving assets into certain portfolios with certain ratings. And they got an insurance policy betting against it, knowing that it's going to fail. Okay. So it was unbelievable. And they made hundreds of billions of dollars. For example, what was it? Michael Berry, the guy who founded this, he invested probably about $2 billion into an insurance policies. Okay. That bet against his own portfolio in which they bought mortgage-backed securities, and he made $469 billion in insurance. He only invested $2 billion. They made $469 billion. So when you see how this shit's called a CDO, you guys will pay attention to this movie. When you see how Wall Street literally will move around and care less about us down here, the ones that have been in 2008, and this type of PR is coming out, and it's that black and white, and it's just being exposed. It makes people go, you know what? I'm done believing in, NVIDIA in some cases and other stocks. I'm going to pull my money and I'm going to invest into something that'll be a little bit more stable, but I can control, I can drive by it. I can smell it, taste it, feel it. And that's where the world's going. So hope that makes sense for you guys. Love y'all. Hit me up on social media. Keep following along. I will probably have some shorts off of this. But I really do appreciate all the support. And if anybody has any questions, happy to dive into a deeper conversation over the phone or on social. So thank you guys. Have a wonderful day. To my team, Paradigm, thank you for all your love and support. I couldn't do it without you. And just for you guys to know, I can't do this without my team. I am the visionary and I'm the crazy guy, but they are the ones that hold me down and kind of try to catch up because I'm just kind of crazy. So, all right, guys, love you. Hope all's well. Have a wonderful Thanksgiving. Merry Christmas. I probably will do the next webinar in January, and I'm going to do one with some really big influential people that have done billions of dollars in debt. One guy is from George Smith Partners. So I want you guys to look up George Smith Partners. They just bought the company out for $104 million. They're the largest advisory firm on debt. So they finance high rises and large master plan communities. They're working with institutional and retail investors on equity. It's amazing on what they're doing, but they do massive, massive volume. So I'm going to bring those guys to the forefront so you can hear their sophistication and what they're doing, but it's going to be right in line with what we're doing. So, all right, guys, have a good one. Merry Christmas, Happy New Year's, and happy Thanksgiving. See you later.